Now the second quarter losses widened to about 620 crores for Swiggy, but the results were driven by quick commerce business that saw a 31% growth versus last quarter. In moments from now, we'll be joined by Sriharsha Majeti and Rohit Kapoor, who is the group CEO. But let's pull up the chart of Swiggy if we can, before we get the management. Swiggy should be up on the screen because that stock has gained about 3% because the read-through of the numbers and the growth that they have put out has looked okay to a lot of analysts, and hence let's get them on in the screen. Gentlemen, thanks so much for joining in. Shreyas, the first question to you. Put the quarter into perspective because growth looked okay. Hyper growth in quick commerce seen as well. Is this a sign of things to come?
At a high level, even if I look at the overall Q2, I think it's a sum of many parts. I would say that we've done a lot of work over the last 1-2 years to make the food delivery business stronger, improve the fundamentals, and that has freed up time, for the management team as well to be able to focus on, let's say, the growth agenda, the innovation agenda, in a way that maybe we haven't been able to for the last 2 years while we were managing multiple listings. But now, as you look at the trajectory overall, I think we're very excited with the progress that we've made on the contribution margin of the food business. We've demonstrated operating leverage, and we feel good about the overall path and how we're rowing together. And we are expecting to, we have guided for, let's say, a high teens in growth rate on an annual basis. We feel good about the overall path on growing profitably to get closer and closer eventually to our steady state guidance of 5% EBITDA in the food business. In the quick commerce business, it's a different story in that, let's say, the category is obviously going through hyper growth. We had a strong growth quarter in Q2, but I honestly think that it's really, really early days for the category, and we are still maybe 10% done, on what it can be, let's say, in the next 3-4 years. The category will see heightened competition. There are some quarters that are going to be up, some quarters down in terms of growth rates. But I think for us, the key is to constantly keep just thinking about like the consumer needs that are latent and stated as of today, but also keep finding out what they may need tomorrow. And on an overall basis, we feel good over there. We're expanding our city footprint. We're expanding our overall square footage footprint on the dark stores. We're growing it by 2.5 times from March 24 to March 25. That's a reflection of our ambition, and we feel like we are getting started in quick commerce. It also allows us to add a lot more assortment than we have in the past. So even there, a transformation is underway, but it is a competitive category, but growth is expected to be overall strong for the next few years for the category, given the early penetration stages we're in.
Shreyas, there is a feeling, a repeat question to you, but there's a feeling that heightened competition is coming in from the players who are not in the industry thus far. An unlisted player we know is burning capital as well. How difficult will it be for you to scale while maintaining profitability metrics because you are listed?
I think, Neeraj, our compulsion is to build the foundation for a very strong long-term sustainable business. Even in the report that we published earlier this evening, we're guiding to an overall contribution margin break-even on the quick commerce business in October, November, December 2025. And we understand that the path may not be linear, but it is imperative for us as companies to be agile and responsive to what we see in an evolving landscape and make sure that we're able to do this and that. So everything that we think of is how do we make Instamart successful in the long term, and if it means modulating investments in the short term, we have talked about how we will not shy away from it. It is important. Like I said, it's the very beginning of a $30 to $50 billion category, and we may modulate investments in the short term, but we're still giving the guidance that the contribution margin will break even by OND quarter of 25. EBITDA for the quick commerce business at some time in July, August, September 26. So we still feel like we can do this and that, but the key is to constantly keep thinking about how to keep the business strong in the long term.
Okay, Sriharsha, EBITDA and profitability guidance is probably in line with what you said pre-IPO, if I'm not wrong. Break even in 6 quarters, so the October, November, December quarter. What factors go behind these metrics?
So I think actually we haven't given any guidance pre-IPO about profitability timelines. Constantly we kept saying that we'll talk about it in our first earnings call, and finally we were able to do it today. I think when you look at, let's say, the mix of the businesses that we're in food delivery, as Rohit mentioned, we've already gone from, let's say, a 0.8% to 1.6% EBITDA sequentially in a quarter's time. And we will keep getting closer and closer to that steady state design of 5% EBITDA. So that is one part. So the food business is continuing to grow at the high teens level and will keep increasing its overall profitability. So that will generate some money. If you look at the other business that we have, our dine out business is growing and is also on the verge of turning profitable as we enter the last quarter of the year. So take that. There are two machines. Obviously, the food delivery machine is the larger profit generator. Dine out, going out business also will start generating a little bit. And then you look at, let's say, the overall guidance that we've given for Instamart, while continuing to modulate investments, mindful of, let's say, the competitive scenario. We also believe at the same time there are a few factors that give us confidence in our ability to get closer to the contribution margin breakeven. If you look at it, firstly, there are some revenue line items. We have, let's say, some ground that we can cover on the average order value size. As we add assortment, we feel good about our ability to grow the AMV. I do also think that we have opportunities to grow our advertising revenues in the Instamart business. The third thing is, if you've seen our overall store guidance, we're guiding to go double the overall store count and almost grow the store square footage footprint by 2.5 times. That happens in March. After that, the overall maturity of the average store will start improving. So these three things, coupled with, let's say, our best guess on competitive intensity as things stand today, then coming together, we still feel like we should go gun for contribution margin breakeven in Instamart and OND25. So it's a coming together of foods growing profitability, going out, turning profitable soon, and a path for Instamart to get closer to contribution margin breakeven by October, November, December 25 quarter. It's all these things together, to be honest.
Okay. Rohit, one question to you. The pace of market share gains or losses, does that worry you? The last statistic that at least we saw, your competition has gained quite a bit of market share at a rapid pace. You've kind of gone up and down the curve on this market share game as well. How do you guys think about it?
First of all, the market share there is, as Harsha said, we are very early in the game there. And the way to think about quick commerce is probably if you're in a football match of 90 minutes, we are seeing what's happening in the first 5 minutes. And things change all the time. And new players are coming in. So frankly, I think the way we think about the business is whether you're acquiring the right set of consumers at a certain volume to make a very large play over time, and also continuously improve the economics of the business. And we have also lived through this journey as a company, because if you go back 8-9 years, there were multiple people in food delivery. Like, probably Harsha will know better, like probably 8 to 10 players out there. And today, there is certain configuration of the market. I think the quick commerce market will also not exactly evolve in that direction, but we will see it change quite a bit. So the rather than focus on market share, frankly, none of which is publicly available as well in terms of numbers. And one point we do want to make is we'll rather, in terms of numbers or any share claims, rely largely on the basis of two listed players out there, which is Blinkit, which gets reported under Zomato and us, rather than focus too much on selective numbers thrown about by private competitors who probably don't have the same bar on reporting and information provision that some of us need to provide. And I think that Harsha has made a point recently in an interview where private competitors or private companies which are large enough should be also looked upon in terms of information disclosure in a certain way. So I think 3 points. One, the market is evolving fast. Second, new players are coming, so shares will be dynamic. Third, feeling very good about the trajectory of the business and the way the economics is shaping up, the way consumers are continuing to accept more and more assortment categories coming into quick commerce. I think we are in the early stages of probably a $40-50 billion category being created out here.
Well, we wish you all the best for that category creation. Gentlemen, both of you, thank you so much for taking the time out and being with us today. That's the management of Swiggy on the numbers and the outlook ahead. The stock has done well today. A clutch of brokerages, like I said, have come out and, well, you could argue given a bit of a thumbs up to the Swiggy numbers as well. So interesting, the outlook on this one.